Welcome to the April edition of our U.S. Economic Podcast. I'm Greg Dacko, Chief U.S. Economist at Oxford Economics, and I'm joined today by Kathy Bostiansek, Chief U.S. Financial Economist. First thing that is quite important to note, Kathy, is that the U.S. macro team recently placed fourth in the Wall Street Journal Economic Outlook Survey. So that's a ranking that's done every year and quite highly regarded in terms of ranking. So we're quite proud of that achievement. And we also won the MarketWatch Forecaster of the Month contest for the month of March. So another good performance for the U.S. macro team.
So the pressure's on, in other words, though.
That's right.
Continue this, to continue this recent track record, and maybe on that note, you could kind of fill us in on what the latest developments in outlook is on the U.S. economy.
That's right. Our crystal ball is pointing towards some weakening in economic activity, but that's not surprising. We had expected last year would see a temporary boost to economic activity, and we did reach growth of 2.9% on average in 2018, which was the strongest performance since 2015. But we are seeing some weakening in economic data. That does not mean that the economy will come to a stall. We still have strong fundamentals. In particular, the employment data is quite strong. We continue to have a labor market that adds more than 200,000 jobs every month and has been doing so for a number of years now. We have private sector confidence, in particular consumer confidence, that's elevated. We still have a little bit of fiscal stimulus working its way through the economy, though I would think that we're not too far from having reached essentially the maximum boost from the tax cuts portion of the fiscal stimulus. Asset prices have rebounded, which is being a big help in terms of wealth and confidence. And while gas prices have rebounded, we shouldn't forget that they actually fell quite sharply over the course of 2018. So overall, we expect consumer spending to essentially grow more or less in line with disposable income growth. And that should be a pace that's in the 2.5% range, which is decent, not excessively rapid, slower than what we saw in the recent past, the recent few quarters, but still a fairly decent pace for economic momentum and consumer spending in particular.
So the consumer looks to be in pretty sturdy footing here. Labor market's still looking good, income gains, even though the savings rate's been a bit higher, I think. That's elevated right. Than maybe some had expected. But then when we pivot and take a look at businesses, what's the outlook there in terms of business investment and also inventories, right? We've had a bit of higher inventory accumulation over the last couple quarters.
Yeah, I think we saw part of the inventory accumulation that resulted from weak demand and trade disruptions. The combination of the two factors, I think, led to that surge in inventories accumulation. From a business investment perspective, both in the data and what we're observing is that there's been a cooling of business investment momentum. We see that in the data, but the leading indicators and our clients are telling us that conditions overall remain relatively strong still. So we're not in this stall mode for business investment, and that's quite encouraging. I think one thing that's quite interesting in that dimension, in that dynamic, is what's happening on the inflationary front. A lot of questions are being asked as to where inflation is. Why is inflation not close to the 2% target or even slightly above the 2% target when you have such tight labor markets and such tight capital markets? So what's our view on inflation on that front?
We think inflation still stays relatively low and actually struggles in a sense to reach the 2% target on a sustained basis. And in fact, that's because that's what the Fed wants, right? They want full employment, but they also want inflation at 2% and sustain that. And we won't really get there. Even with oil prices a bit elevated, talk about gasoline prices, the latest consumer price index data did show an acceleration on the year-on-year rate. But even so, unless you keep seeing increases in gasoline and oil prices, which is not our forecast, it's going to level off, really hard to sustain that pace. And when you take out food and energy, core inflation is much more muted.
Last week's readings on core PPI, core import prices, and core CPI all fell to new lows.
That's right. So there's still this conundrum in a sense, and I think the Federal Reserve is struggling with that, trying to understand why is it you have some moderate increase in wages, you have a very tight labor market, you have a pretty robust economy that's late in the business cycle, and yet there's no signs of real inflationary pressures. That is, of course, part of this framework overview that they're evaluating at this point. But I think the other thing that's somewhat surprising is trade, right? Because the tariff increases should also feed through to inflation. Right. On the other hand, we also have to worry about trade and hit the confidence, whether it's business or consumers, and also what does it do to trade flows? So what's our latest view on that?
Well, the latest news is relatively encouraging. We've seen some positive echoes from the discussions between the U.S. and China. That being said, there remain underlying tensions. So what we see as a potential deal from the U.S. administration's side is essentially a deal that would have China promise to purchase more goods from the U.S. There have even been rumors that the administration has asked China to switch the tariffs away from soybeans and agricultural products to signal that as a win. And move into other goods. But there is essentially that desire to show some form of a win with China importing more, with China promising to control its currency and to enforce intellectual property rights. But the underlying tensions, the strategic ambitions on both sides, and the very strong ideological beliefs on both sides will likely prevent a comprehensive and long-lasting trade deal. So we see lingering trade tensions going forward. And that is one of the reasons, one of the factors for the slowdown in global momentum. And that has, over the past few months, past few weeks, continued to feed into this underperformance that we've seen around the world, and in part led to the inversion of the yield curve about 3 weeks ago. It's since reverted. So that typically is a leading recession indicator for the U.S. How should we perceive this relatively significant movement in the yield curve, the inversion, reversion? What does that mean for the U.S. economy? Does that mean we're headed into a recession?
Well, it's something we shouldn't dismiss, and we should be, sensitive and aware to. But as you said, long-term rates, which are really dictating really where the yield curve goes, because right now the Fed has told us they're on hold for an extended period of time.
Yep.
We think they're on hold, done tightening for the whole business cycle. So that means the yield curve is really going to be dominated by medium to long-term interest rates. Now, over the last few weeks, you noted the yield curve kind of steepened, and that's because 10-year yields rose about 20 basis points. Mm-hmm. So some of these recessionary fears about a global slowdown have been diminished, and therefore that actually allowed interest rates to rise. So I think that's the phenomenon. That's what we're going to have to watch going forward, and it's going to be very much dependent on the data.
Yeah.
The Fed's dependent on the data, but in a sense, they're telling us even if growth is a bit stronger, if inflation doesn't accelerate, they're not going to do a lot. So I think the movement in what's going to happen in the interest rate front will be purely driven in the bond market. So
yeah, and we've seen some of the global worries that led initially to that inversion of the yield curve sort of dissipate to some extent. The positive trade news, the Brexit can that's been kicked down to later this year, and green shoots in Europe and perhaps initial green shoots in China in terms of a turnaround in momentum. Those have all helped, I think, expectations and allowed the recession bias to slowly dissipate. Something we've been adamant about is that we should not fall into that trap. But in terms of the Fed, Kathy, we don't foresee any more rate hikes. Why do you think the Fed will likely stay on hold?
I think the big reason is unless we get a real big increase in inflation, there's no reason for the Fed to act on the upside.
Yeah.
They set the bar high. They want to see an acceleration. In fact, we had Chicago Fed President Evans, who's a voting member of the FOMC, said he would like to see go up to 2.5%, and the Fed to be comfortable with that. That's another story if we can get there.
Is that a wish, though?
And yeah, exactly, more wish than the actuality. I think on the downside, there's questions as to what would get them to actually ease, and right now there doesn't seem to be data points suggesting that either. So sort of this, elongated wait period, but it also lines up well with the research we've done right on the neutral Fed funds rate.
That's right. We found that we're not too far from the neutral rate, maybe 10, 25 basis points from the short-term neutral rate and maybe 25 basis points lower than the long-term neutral rate. But in all likelihood, if we continue to get this environment where inflation continues to undershoot the target, that likely implies that the real neutral rate is actually somewhat lower, or else we would be seeing somewhat faster inflation. So it may be that actually monetary policy is a little bit too restrictive, but that is not yet our conclusion. We think that core inflation in particular, will hover around that 2% mark. But that headline inflation after missing it because of energy prices, will converge back towards it, but quite slowly over the next few months. I think we've covered a lot of topics today, Kathy. Thank you very much.
Yeah.
And we'll speak again for the May podcast.
Thanks, Greg.